Hello everyone, this is Juan Sarmiento and today is Thursday, November the 5th. Let me start with both two candidates that I have worked out in my Excel spreadsheet. These are Qualcomm and Facebook. Okay, first, Qualcomm has great earnings, 34% beat, meaning they exceeded the earnings expectations by 34%. And the volatility skew is, well, this is a mistake. Let me try that again. The volatility skew in Qualcomm, let's see. The front month is down here, 35.56. 36.78. These are the two low point here, lower. These are the expiration December. That's the trade I'm considering. It's a March, December. Strike price 145 is the closest to the current price. And as you can see, two puts, two calls. I can do twice as many. Let's check this spreadsheet. So let me get first the difference in volatility is practically nothing. So that's positive. The liquidity depends on the price. So then when we say create duplicate order, we see the range between mid and natural. That's a little too wide. So what happens with that, it may be hard to get in and get out of the trade. Okay, depending on how good the trade is, you might decide to stay in. Change that right now. To keep on trying until it gets filled, and then getting out, it might be difficult. So 4% is not that big a deal, but the current IVE percentile, I have the 20%, the 15% is my cutoff point. So that's a negative, that's a no. But based on this other, particularly the difference in earnings, I'm very motivated to enter the trade. That's why I say, okay, I live with the issue of the liquidity, and the current IV percentile, that's a risk I'm taking, but I'm willing to live with it. The chart will show you the implied volatility has already declined quite a bit during the day because of the jump. And you can see the stock is hitting new highs, which is also a good feature for me. Why? Because it might continue much higher, who knows, or if for whatever reason the market decides it's time to take profits, it's coming from the very top and could collapse and make money. Who knows? I don't know. You don't know. This is why I trade the Gini trade, okay? Because I don't know for certain. And I'd rather not take that chance. Okay, so the price is 38.85. So I can put that here. 38.85 times 2, that's 700. How about if I did 3? No, that would be too much. If I did 3 lots, it would be 11,000. That's way above the 10% of my account. So I'm going to stick with the 2 lots. Okay, I can copy this here and paste it here. It's already on the go here. 38.85. I unlock that, so make sure that it's at the mid, at least at the beginning. And I'm going to do 2 lots, so that means 4 longs and 2 shorts. That's 2 lots. Okay. Let's send that off, and we wait. And you can see it's $7,776, and then I have $11,000 left for my second trade. And the second trade is Facebook. Let's look at the chart of Facebook. And there's go. It looks like it's going to break to new high. But if it forms a double top and then collapses, who knows? I'm just as happy. The volatility is a little too high, but not so much in the back month. So let's take a look at the Excel spreadsheet for Facebook. And here we are. I'm doing only one lot of 7,000 of $7,470. That's a big single trade, one lot. That's because the price is so high. And you can see I have plenty of green here, only the current IV percentile that is, but the beat of earnings is so large that I'm very motivated to play it, to do this trade. The IV percentile is rather high for the options that I'm buying. It's close to 40, but that's my cutoff point is 40, so I'm going to take that chance. It's still green, and you can see the difference between the two. Volatility is less than 3%, so the skew is acceptable even if it's not favorable. And then we have the liquidity is plenty liquid enough. Obviously, it's Facebook. So what do you expect? Okay, so then I copy that. And you can see the trade that I'm trying to make here. Let's analyze that, okay? Here it is. And you can see that is the 295. The stock is trading at 295.72, so that's acceptable. I'm buying the February, which is more than 90 days to expiration, and selling the December, which are close to 30 days to expiration. Get it? Okay, so let's do that. Create duplicate, confirm and send. No, let's say create duplicate. And then here you see the mid and the natural. And in my Excel spreadsheet, I'm certainly doing that comparison. And is the difference between the two is 2.4. The options are liquid. You should not have problem entering and exiting the trade. That's what it means. The IV is a little high for this stock. Proceed with caution. And because the volatility being low, it may be hard to get in and get out of the trade. Okay. And that's all. Okay, let's look at all the trades and see which ones need to be changed. Apple. You can see that I have November versus November the 6th versus November the 20th. So it makes no sense to even try to do this to December, because then your short will be past the expiration date of your longs. So that makes no sense. We can begin to close it by going to November. Close the position. That's what we should do. It's kind of messed up, but what we do is close the, let's say, roll over these calls, analyze rolling, and to November the 20th, and just do two of them, and that will be closing my two long calls, these here, and my two of my short calls. That's where we start. Let's simplify this. By the way, the Facebook trade failed. Okay, now you see we have 5 calls here, short, and I mean 2 short calls and 2 short calls and 2 long calls. All right, so what we can do is roll it up to the next month or just close it. Let's close that. Analyze closing, diagonal. Get it? I'm closing my short calls and I'm selling my long calls in order to compensate. See that? And I do get a credit. And I will end up with 2 long calls. Let's see what we end up with. We will remove this and remove that. Okay, so now we have the short puts and one single 125 call. That's sort of great if Apple really takes off, and it looks like it's doing. I'm going to leave that almost like a afterthought. Close the puts. I don't need that. Or actually, this put is expiring. It will probably expire worthless, these 5 puts. But if we close that, calendar, here, then I end up with 6 long calls. Let's sell that and just keep the long call. Custom. Great, and that's a credit too. And Apple is liquid enough, so it should be no problem to do this. Okay, now we have a 125 call. It's like a lottery ticket. If Apple's able to go over 125 by the end of the month, we will make good money with that. But right now is, if I close that, will give me $1, $112. So you might want to sell and get that money, or you can also even sell a call at a higher strike price to compensate a little, and then you end up with a diagonal. I think what I'm going to do is leave it like that. Let's move on to ATVI. November 6th, that looks great too. Is moving up nicely, had good earnings. Yes, so I'm simply going to roll this over. Not expiring is the call that is likely to expire. So you would be doing that with the call. Leave the calls alone, add to the calls tomorrow, and the puts you would be doing today, roll them over today. But instead of that, let's just do the rollover on both. Yeah, and let's sell the December 4th, and that gives me $320. It turns negative. I don't like that. I don't like that, because my deltas turn negative if I did the rollover only. But if I did the call side first, that gives me $632. Let's cancel that and go back and do both together. With December expiration, but I could reduce or increase the number of puts by 1 that I'm selling, just 1, and bingo, it turns delta positive. Did you see what I did? Okay, I would be rolling the puts and calls to December. But when I did that, if I did that, my deltas will be negative, and the market looks bullish right now. And this is a stock that it looks like it's going to break to new highs. It's breaking through my trend line here. Okay, so I'm a little bullish, just a little. So I want to neutralize my delta, not leave them hanging this big negative. So I will simply increase the number of puts by 1. And that neutralizes my delta. And I'm happy with that. That's one of the tricks you can do if you have plenty of lots, if you have several lots. Let's go to BABA here. BABA is November 20. I need to do nothing. If it was the 15th of November, no, the 13th of November, I should do that because that's 8 days to expiration. DJX, nothing to do here. DHR, November the 20th as well. Facebook got filled. Here it is. Home Depot, this is the one that I was having problem filling. Got filled. November the 20th. December the 4th. This is Lowe's. Leave that there. November the 20th. Qualcomm, still not filled. Let's change the price. Yeah, I'm paying more than what is bid right now, so I don't need to change anything. I will check this out before the market closes if it doesn't get filled. Okay, November the 13th. This we definitely need to consider whether we're going to close it or not. Now pay attention to this. You see the current price is in my smiley face. So I almost don't want to do anything. My deltas are close to neutrality. I'd rather wait because if the market falls, by expiration it falls in my cone, this will make it profitable. Okay, so I'm gonna leave that and check it out next time. Okay, so that's because we are so close to expiration and my strike price is very close to the top. If the market continues on higher, that's fine. My deltas are positive. If it drops, it will land in my cone, and these November expirations, November the 13th expirations, will help me with target. UPS, November the 20th, nothing to do there. Okay, so there we are. Great. Let's take a quick look at the markets. Markets are rallying after the election. That looks like a ABC, so that was a correction completed for the Dow. I'm using Elliott wave parlance in case you wonder. You have an ABC, that's a complete Elliott series, which means the market could, and by the looks of it, it's moving really strong, it's going to break out. Okay, that's for the Dow. Let's look at the NASDAQ here. And let's put the daily chart. Same story, ABC, that's a flat correction by Elliott wave, and now it looks very strong, especially yesterday. Today is a follow through and looks like it's going to break two new highs. And then we have the volatility is declining very fast. That's why our profits were cut a little bit. But if the market breaks out, it will make our money. Don't you worry about that. Okay, that's all for today. I will keep an eye on these. I expect them to be filled. Let me just right now change this. No, that should be okay. My credit is less than and my debit is more than. So this is fine. They should fill. And so I will check them out later and I will make sure that gets filled even if it is at a less favorable price. Okay, so don't take this as an absolute. And that's all for today. Thank you very much and see you next time. Bye-bye.
Please be sure to subscribe to this channel by clicking on the subscribe button below. Once you have done that, be sure to also click on the bell so you get a notification of future videos coming up in this channel. Be sure also to click like if you enjoyed this video and feel free to share it with your friends and family. Thank you very much.